let's just jump to the punchline. When the market goes up 3 or 4 or 5% in a day, it absolutely lights up our brain chemically. And we go, oh my God, it's over, done, let's get back in. And I want to talk about what these 3 to 5% up days, what that's really doing, what's really going out, what that's really telling us in the market, because I think the market is doing something that you might not be aware of. We're going to cover that today and so much more. Stick around. Hey everybody, this is RC Peck, and this is my weekly update. My goal of this video is to look at things that maybe other people aren't looking at. And I want to look at a handful of data today that probably people haven't been introduced to. I did a free live what is going on in 2022 video Zoom meeting this week. Right now I'm recording this the market hours are almost closed on Friday. But what I want to do is kind of look at things that maybe you aren't being presented to help you understand and give you clarity and more control and really just more understanding about what's going on with your money. So let's do this. Let me jump over to the first price chart. I'm going to look at a few price charts, then I'm going to look at a couple data points. So if you look at this price chart, let me make my screen even brighter. This is a 25-year time range of the NASDAQ 100 index, the NDX 100. QQQ captures this, but it's not exactly the same because the Qs actually have dividends in them, and this is an index without dividends. But what I just want you to see from the 09 bottom, which is where the red lines start, that's what the market's been doing. Let's just call that 13 years. And so what I just want to point out is we're still in this trend, right? We got above the trend and we came back in it. It's very likely we could come down and touch the bottom red line. That could have been it. That could have been the fall, a 33, 34% fall in the NASDAQ 100. And it's off to the races again. You could absolutely have that again. Again, this is a very long-term kind of chart. Let me show you another long-term. This is the S&P 500 index. This is also the same time range, 25 and a half years. Super much easier for me to block in the 2000s where the market had 250+% drops. But again, since 09, you can see the market stopped falling. And the SPX, this is SPX, this is the S&P 500 index, no dividends included in this. This is not a tracking symbol of the index, it's the actual index. And you see a very similar thing, that the prices move down, it could absolutely move down lower. I've talked in past videos how this pre-COVID high for the S&P, that'd be about a 33 to 35% drop. That's still on the table and nothing would be hurt, nothing would be harmed. The trend, this gorgeous 13-year trend would be in place. So look, the longer something's in a trend, the stronger it is. So it has not broken the trend at all. It's still trending higher. Now, if I change this and just look at what's going on today, this is the S&P 500 with dividends reinvested. And that's kind of what's going on today. So that's about a 7-month trend down. Now that smaller trend is within that larger 13-year trend. This bottom here is where interest rates stopped going up, where the yield on the 10-year treasury stopped going up. And you'd see the same thing also on the Qs. If you looked at the Qs today, the Qs have kind of the same thing going on. We're still in a downtrend. Now, within this downtrend, you can see these moves up. There have been, you could say there's 1, 2, 3, 4. The biggest one was 17-ish plus percent right there, and you've had a couple smaller ones here. And so that's the market we're in right now. The thing that I find interesting, and let me bring it up here, is this price chart right here. And I showed this week on my live call. This is the NDX, so this is the NASDAQ 100, and this is every time it has, let me just put this over here so you don't need to look at this. This is every time it's risen over 4% in a day. Now, what I want you to see is the yellow dots. So all the times the NASDAQ 100 did a 4+% in a day, More than not, this is going back to about 1986, right? This is where the NASDAQ 100 started. And your brain can probably see these 4+% days, not all of them, but almost all of them were in periods of instability where the market's falling. That's 1987. This is probably, 91, 92. This is 98 right there. This is the dot-com crash when the NASDAQ 100 fell 83%. There were, that looks like 30, 40 times the NDX, the NASDAQ 100 popped over 4% in a day. And then you have right here the global financial crisis where a lot of these happened near the bottom. And then the COVID drop where the NASDAQ actually did really well. It only fell 28%. And so we have another one of those 4% up days. It could be the only one we have, could be done just like right there in 21. But typically these things clutter together, and a 4% up day, 4+% up day in the NASDAQ, that's not a sign of stability. It's actually a sign of a market decline. And we've been in this market decline for 7 months, depending on how you want to, you could call it 8 months if you talk about, or you want to start from the November high, then we're about 8.5 months into this. But we're still in a market decline right now. And so what these increases do is it makes people jump into the market. It makes people get into the market because it kind of scares them in. You either get scared out of the market or scared into the market. But that's what the market is doing today. And I wanted to show you these two price charts, both really zoomed out price charts and then zoomed back in, and talk about this 4% up day for the NASDAQ. The other thing I shared on my kind of market update call yesterday was something that I thought was something really people haven't talked about. And I want to bring it up here in case you missed that. It was an hour call, but these were just a couple things. So this is monthly payroll in the 1970s. The green bars are when it was a positive payroll print. Those tall vertical lines are recessions. And what your brain can see with the orange vertical rectangles is going into recessions, we had positive payroll prints, right? Positive. We had people being hired. And eventually it turned into a negative. And the reason why I think the 1970s is important is because this was a period, and this chart, as you can see, is from Jim Bianco. In the 1970s, it wasn't as if the stock market wasn't growing or the economy wasn't growing. The problem was maybe the economy was growing at 1% to 2% a year, and inflation was 8 or 9%. It's very likely we won't stay at that 8 or 9%. It's likely we could settle down in the 5 or 6% inflation rate. If you have an economy growing at 1% to 2% or zero, let's just be honest, 0 to 2%, especially with the last 2 quarters being negative or close to, well, they were both negative. One was closer to 0, but you had 2 negative prints. So when the economy grows at a 0 to 2% over a decade, and inflation averages that 5 to 6%, that is going to put downward pressure. But what more is going to put downward pressure on the stock market? But what it's going to do more importantly is it's going to create a lot of volatility. It's going to create a lot of volatility. If you've ever looked at a price chart of the 1970s, it looks like the 2000s. A lot of trauma, a lot of drama. And so that's what we're in now. That's what this decade is about, which is higher inflation and slower growth, where inflation is speeding faster than growth is. And so that's the backdrop of really everything that is happening today, is that, is inflation going to drop? Probably not to 0, probably not to 3%. And inflation is worldwide. So this is just not a US thing. And so these are the headwinds, and those headwinds are not changing anytime soon, whether we have a Republican or a Democrat in the White House. These are really overarching themes that are moving into and stabilizing within this decade. So what's the takeaway? Let's kind of land this plane. You really want to have a approach that is not reactive to what is going on today, but more about what is happening in the bigger picture, so you can keep kind of both of those weighed in. I appreciate you being in my world. I appreciate you watching these videos. Please share them with people if you think they are of value to you. Leave a comment. I answer them all. And if you like this, you'll love our other videos. Thanks for being in my world. I appreciate you, and I'll see you on the next one. Bye.